Coming up on Business Incorporated. Major bakers in Nigeria threaten withdrawing their services for the next 4 days. The value of Egypt's export of natural gas jumped by 406% to $2.8 billion in the first quarter of 2022. Plus, Zimbabwe retailers agreed to price goods in multiple currencies. Hello, welcome to the program. I'm Ladi Williams. First off, let's track the markets now, starting in Africa. The NGX has sustained Tuesday's negative sentiment. Intraday, the Osho Index was down almost 0.2% at 52,209 points. Same range with South Africa, though its index remained high at almost 68,000 points. In Egypt, the EGX 30 was trading positive, gaining almost half a percentage point, while Kenya closed deeply in the red on Tuesday, lost more than 2%. And moving to the Middle East now, investors displayed more positive sentiments as all the major markets we track were trading in the green. Abu Dhabi gained almost 1%, while Dubai index followed closely with 0.79% at intraday. Another region, Saudi Arabia, was up 0.63%, while Qatar led the pack with a gain of over 3%. All right, now let's head on to Europe, where President Putin has intervened in the growing controversy over Russia's gas supplies to the EU. He says flows down the main pipeline to Germany could be further cut. Let's hear more now from Rob Watts right there in Berlin. Great to have you, Rob. So the scheduled resumption of Russian gas supplies is down the key pipeline tomorrow, but it looks increasingly unlikely to happen. What's the latest?
Because it's iconic as well, isn't it?
Yeah. Well, now Russian President Vladimir Putin has spoken on the issue. This all relates, remember, to the Nord Stream 1 gas pipeline, which is Russia's biggest gas link with Western Europe. It's been idle for maintenance work since the 11th of July, but flows through Nord Stream 1 had already been significantly reduced before that date, raising a great deal of concern among importers in Europe. Now, President Putin has stepped in to say that if flows return, which they're scheduled to do tomorrow, they could be even lower than before the shutdown earlier this month. He said this was because of the slow progress of maintenance work on one of the gas turbines at the pipeline. This is the same reason as was given by Gazprom for the initial choking off of supplies, but which met with enormous skepticism in the West. The turbine was actually being repaired in Canada, and its return to Germany was delayed by fears that it would break international sanctions against Russia. There was a whole row over this. It's now thought, though, that the turbine has been sent back here to Germany. Putin says you can't blame Gazprom for a lack of capacity when the turbine simply wasn't in place. This intervention by the Russian president will not have allayed any fears that Gazprom, though, has no intention of restarting full flows down Nord Stream 1 as Moscow seeks to retaliate against Europe for its sanctions.
So how is the EU preparing for the potential long-term loss of Russian gas supplies?
Well, today it's setting out its emergency plan to secure its gas supplies and avoid a crisis this coming winter. A draft of this plan has already emerged, and that suggests that the European Commission will simply urge member states to continue voluntary measures to reduce their consumption of gas so that the reserves can be filled up quicker. They're expected to be encouraged to reduce usage by 10 to 15% or thereabouts. However, the plan also looks likely to include provisions for a, quote, binding gas demand reduction target to be implemented, should 2 or more EU countries fear an emergency situation because of low supplies. That would essentially mean that the whole bloc was compelled to reduce its gas usage. Now, that could obviously take many forms, including reducing domestic gas usage by Europeans and also, more likely, reducing gas usage by industry. This plan is being published right off the back of that warning this week from the International Energy Agency that the EU's efforts to secure more gas simply won't be enough to get countries through the winter should Russia decide to switch off the taps altogether. And as we're seeing this week with Nord Stream 1, Russian supplies are far from stable.
Right, yeah, they are far from stable at this point. But a key European Central Bank decision looms right now. How are markets doing?
Well, European stocks made a positive start to Wednesday following sharp gains on Wall Street and a rally on Asian markets. The mood is somewhat bright following strong corporate earnings reports from the United States, but also because of that scheduled resumption of gas supplies along Nord Stream 1, which is due to take place tomorrow. Investors are clearly taking some relief from the fact that at least some flows may resume tomorrow, even if they are greatly reduced from the key pipeline's usual capacity. Traders are also awaiting tomorrow's decision from the European Central Bank, which we've been talking about all week, haven't we? The latest development on that is that Reuters news agency believes policymakers at the ECB are considering raising rates by a bigger than expected 50 basis points rather than 25, so by 0.5%. That news pushed the value of the euro higher. In fact, during the course of Wednesday, the single currency reached up to its biggest one-day gains for a month, having hit the depths of parity with the dollar, you may remember, just last week.
Yeah, I see the euro gaining some grounds there. Thank you so much. That was Rob Watts right there in Berlin. Let's head on to the UK now. We have Juliana standing by right there. Great to have you, Juliana. We've seen Netflix in the news. This time lost almost 1 million subscribers. Looks like some of you guys are not subscribing to Netflix at this point.
You're absolutely right. It's a really difficult period for Netflix, which still is the world's largest streaming service. The data doesn't lie, and it does show that they lost almost 1 million subscribers in the first quarter. And this obviously follows from 200,000 loss of subscribers in the first quarter. Already this year, they've lost 2/3 of their market capitalization. And the reason why is because, you know, there is just stiff competition out there. Over the past couple of years, we've seen rivals such as Disney Plus, Amazon Prime, Paramount. I know there are several others, you name them, but it is begging many people to ask, do I need Netflix when I can get my kick from elsewhere? One of the reasons why Netflix's share price actually extended in Wall Street in after hours trading is because investors did think it could be much worse. I think they had penciled in about a 2 million subscriber loss for this quarter. But nevertheless, people are concerned. I think one of the ways bosses are trying to claw back some revenue is to look at how they can monetize the platform even further. I believe they are mulling over a cheaper subscription plan of £2.99, which would mean that viewers would be seeing ads. They recently teamed up with Microsoft to try and help them with that algorithm, and they do want to crack down on sharing. And now, according to their figures, about 100 million households are currently sharing their Netflix password. So you can imagine just how much that's costing them. But yeah, it is a really interesting time. We know that consumer habits have changed so rapidly since we've all come out of these COVID-19 lockdowns. And because of high cost of living, not just here in the UK, but across the world, people are starting to question whether they need 8 subscriptions a month if they can get everything they need from just one subscription.
Sharing a big issue there for Netflix. But another company in the news now, Royal Mail, they threatened to split up the business as it reports about £1 million loss a day. Can you tell us more about this?
Yeah, really interesting story. We'll update from Royal Mail. This morning they updated investors on how they've been doing in the quarter between April and June. In fact, that they lost over £90 million, as you said, £1 million a day, and not great for them. And it comes just 24 hours after 115,000 of its workforce decided that they are going to go for an industrial action. If you remember, a couple of weeks ago, we had rail strikes, the biggest rail strikes in British history, affecting about about 50,000 staff, 115,000. That is really going to have a knock-on effect on Britain's parcel delivery service. But one of the issues that Royal Mail have been having, and they've been saying this consistently, is that people are just not sending letters anymore, and that was the foundation of their business. I don't remember the last time I sent or posted a written letter, Laddie, because most people are doing emails. They have been doing significantly well in parcel delivery, but we do know that, of course, there are so many other competitors. So bosses did announce to investors today that, yes, they are mulling over perhaps splitting their business to a delivery-focused service and a letter-focused service. And they did that really because they want to try and alleviate some of the tension that has been caused, stirred up by union bosses. But another interesting announcement from today is that they may consider changing their name from Royal Mail to International Distribution Services. So we'll just have to wait and see. But nevertheless, in the quarter, they still had over £1 billion worth of revenue. So there was a loss, but still plenty gains there too.
Still plenty gains. Quite interesting. But we got that red-hot inflation figure. How are the markets reacting to that?
You're right. Inflation figures, according to the Office for National Statistics, in June reached a fresh 40-year high in the UK of 9.4%. That's a jump from 9.1% in May. Again, the big items, food, fuel, oil, are the reasons for that upward trend. Not great, particularly at a time where the country is going through its worst cost of living crisis. And we discussed, didn't we, earlier this week, the fact that wages are just not growing as fast as an inflation. So we're likely to see more strikes, not just later this summer, but closer to the autumn. So that's had a knock-on effect on the FTSE. The all-share is down 0.04% at intraday. The FTSE 100 down 0.15%. But the domestic market, the FTSE 250, that's currently up by just over 0.5%. In the currencies market, the British pound is trailing behind the US dollar, down by 0.11%, but up against the euro by 0.12%, and down against the Japanese yen at intraday by 0.21%, Laddie.
All right, Juliana, thank you for that update, and thank you for holding on with all that wind over there. Thank you. All right, now let's move on to Asia. See, shares in Asia Pacific jumped went today after a sharp bounce in U.S. stocks overnight. The Nikkei 225 of Japan rose 2.67% to close at 27,680 points. Fast retailing and Tokyo Electron up 2.59% and 4.88% respectively. The Topix index gained about 2.29% to close at 1,946 points. Hong Kong's Hang Seng index briefly traded 2% higher. It was up 1.5% in its final hour of trade. The Hang Seng Tech index advanced 2.16%. Tencent dropped 2.1% and Meituan added 3.91%. And U.S. stock futures traded lower today as traders continued to review corporate reports. In a busy earnings season, Dow Jones Industrial Average futures dipped 72 points, while the S&P 500 and Nasdaq futures declined 0.2% and 0.2% respectively. We have our correspondent now, Marie Bird, with yesterday's close in the U.S.
0.43%, the S&P 500 up by 2.76%, and the heavy tech Nasdaq was up by 3.11%. Many investors were excited about the company earnings reports and are hopeful for the days to come. But many are still watching to see what will happen within the next 12 months, as it is expected the economy will begin to slow, and we could see a slight recession in the U.S. economy.
Right, so still cautious optimism right there in most markets right now. All right, after the break, we check all the stories on the African continent. That's in a moment. Do stay with us. This is Business Incorporated. And now to our next conversation. As global central bankers raise rates due to rising inflation, African manufacturers at risk with rising energy costs coupled with squeezed household incomes. How to boost Africa's output in these times? To have this conversation, we have joined us right now Dr. Olukunle Yonda, Managing Partner, CEO of Brooks Consulting, join us right here via Zoom. Great to have you on the program.
Thank you so much, Ladi.
Yeah, great to have you. So sub-Saharan African economies are raising rates aggressively, as inflation bites at this point. Africa's manufacturing sector is expected to be impacted by all of this. What are you seeing?
Well, there's no doubt about it that with the increase in the interest rate, that is going to impact on the manufacturing sector. There's no doubt about that. And the reason for that is because, well, although you have the official, foreign exchange rate, most manufacturers will not assess that. Now, the reason why central bank has to increase the interest rate is actually to control the inflation. All right. But in an economy like ours that is highly, import dependent on most of their raw materials, from abroad, the forex is off the roof, and not to talk about the fuel, and all of that. If you look at it, the manufacturers of Nigeria, produce about between 45% and 50% of their cost is actually from diesel, from your fuel oil, and diesel. And if you look at the price of fuel and diesel, that is really high. Now, what do we need to do?
All right. See, we have connection issues there with Dr. Yonda. We'll try and get Dr. Yonda to finish his thoughts there. But moving on to other stories now, we see major bakers in Nigeria withdrawing their services for the next 4 days. According to the president of Premium Bread Makers Association of Nigeria, Emmanuel Onora, master bakers will be joining in the strike to protest the high cost of energy as well as other major inputs for the production. Do take a listen.
The government must show concern because as small businesses, we are the drivers of the economy. If all the bakeries go extinct, bread is a staple. It's a food that every Nigerian wants to have on their table. And if it is dried up, then it's going to exacerbate the current challenges we are facing in the country. And we don't want that to happen. And then 2, 3, NAFDAC as an agency, as Premium Bread Makers, we've written NAFDAC severally and our sisters association. Do you look at this? You want to register a pack size. NAFDAC will charge you 30,000. But when they want to renew it, they don't even give you any prompt. They don't give you any prompt. Maybe like a week that they do in auto reg. The next thing is when you are going to renew, NAFDAC will say you should pay 154,000 for a pack size. Where is that done? We've written to NAFDAC, Prof. Adeyeye. Nobody answered us. We've reminded them. Nobody answered us. How can a country run on that kind of impunity where government agencies don't even want to interface with the associations or the industry they are regulating? They are our regulators. And then 4, there's multi-sectoral, multi-agency regulation of bakery industry. SON, NAFDAC, every agency wants to regulate the industry. They think there's a cookie jar for everybody there. They bust into the bakeries sometimes without notice, and all they're asking for is the same thing. Food handlers test, water analysis test, hygiene and all that. All of them are doing the same thing. Why are everybody coming to regulators? It doesn't work that way.
Yeah, the value of Egypt's exports of natural gas jumped by 406.5% to $2.8 billion during the first quarter of 2022, compared to $559.9 million during the same period in 2021. The latest data from the Central Agency for Public Mobilization and Statistics showed that Turkey topped the list of the world's highest importers of natural gas from Egypt during the first quarter of 2022, with an amount of about $917.2 million, while Spain ranked second in the list, a value of $425.7 million, followed by Indonesia and $317.8 million, then France with $303.1 million. China came in the fifth list with a value of $182.1 million during the first 3 months, followed by South Korea with a value of $146.5 million. And then the United Kingdom followed with $140.3 million. All right, now let's get back, Dr. Olukunle Iyanda, Managing Partner, CEO of Brute Consulting. Well, we had issues with connection there. Can you finish your thoughts on how you're seeing, this whole rate hikes and inflation impacting manufacturers here in Africa?
Thank you so much. So I think that even though the central bank is trying to control inflation by raising the interest rate, well, with the nature of our economy, what you see is that it will worsen the inflation further because most of the African manufacturers has to depend on importations of raw materials. Now you don't have Forex. They couldn't get it from the official window. Now that they couldn't get it from the official window, they have to resort to the black market. And now Naira is going between 620 and 621, at the black market rate. So at the end of the day, it will further contrast. If you look at what the manufacturing sector have done in 2021, we had a gain of about maybe 10%. However, with the Russia-Ukraine war, there is a contraction at the beginning of the year. So what do we expect further is, would there be further contractions or would there be an expansion? With what the central bank have done, I expect that it will further lead to a higher inflationary rate rather than curtailing it. In a sane economy, it should have been able to help us to adjust the inflation rate, but I doubt whether that is what we are going to get from the measure taken by the Central Bank of Nigeria.
I think manufacturers should be doing at this time because they're facing, a lot of headwinds. We're seeing most of them actually pack up at this time. What can they do to, survive this period?
Well, that's an interesting question. What do manufacturers need to do? Maybe they need to they need to think creatively. However, I think for manufacturing sector to do better, the federal government has a lot of role to play by ensuring that they have access to foreign exchange, ensuring that the issue of multiple taxation is dealt with, ensuring that the issue of overregulation is also addressed. The manufacturing ceiling. However, there is a limit to what they can do on their own. If we have to say the truth, there's a limit to what they can do. The federal government still need to come in. Take, for instance, you talk about the issue of fuel. What will I do as a manufacturer if diesel is about 1,000 naira? What do I need to do? I can only go to the market and source it at that rate. All right. And what you do is that eventually you pass it on to the consumer. Now, where you have a situation whereby most goods are also smuggled into the country, so which will lead to a higher cost of production for local manufacturers, and consumers want to explore other options of foreign goods. At the end of the day, the manufacturer will be affected, the local manufacturer will be affected because the cost of production is quite steep. So what do manufacturers need to do? Well, they need to look at how they can be more cost efficient, because if they're not cost efficient, the prices of local manufactured goods is going to be very steep and very uncompetitive when you compare it to what you see in other countries.
So much to unpack there. Very interesting times right now, and at the time where Africa is trying to boost output, we need to look inward at this time and try to weather this storm of inflation and rising rates. Thank you so much, Dr. Olukunle Iyanda, Managing Partner, CEO, Brute Consulting. It was great having your perspective on the program.
Thank you so much, Ladi. Thanks.
Thank you. All right, now, moving on, Zimbabwean businesses agreed to solely price their goods and services using the U.S. Dollar, according to an industry group, after government warnings that the local currency should be accepted. The decision was taken at a meeting between business leaders and representatives from the Central Bank Financial Intelligence Unit and Finance Ministry to discuss surging prices right there in Zimbabwe. It was also attended by manufacturers, suppliers and retailers, as well as millers. Well, at the end of the day, what they're trying to bring down prices at this point, with consumers not able to match up with rising prices right there in Zimbabwe. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.